In this video, we turn to property, plant, and equipment. Property, plant, and equipment represents land, buildings, and machinery used in the manufacture of the company's services and products, plus all costs like transportation, installation, and otherwise that are necessary to prepare those fixed assets for their service. Now, where inventory cycle out of the balance sheet and into the income statement as cost of goods sold, property, plant, and equipment cycles out of the balance sheet and into the income statement as depreciation. And that depreciation comes out either via cost of goods sold, just like inventories, or via SG&A or some other operating line item. Recall that depreciation represents the systematic allocation of the cost of fixed assets over their estimated useful lives. Property, plant, and equipment represents those fixed assets on the balance sheet. So suppose a company purchases a $500 machine with a 5-year useful life. Assuming straight line depreciation, and most companies do choose straight line depreciation expense after a full year is $100. So at purchase, property, plant, and equipment goes up by $500, and the cash used to purchase it goes down by $500. But after a year of operations, when you've recognized $100 worth of depreciation from the obsolescence of that machine, you see property, plant, and equipment going down from $500 now to $400. And so we see after a year this $100 credit going down, reducing property, plant, and equipment from $500 to $400, and a corresponding reduction to retained earnings. Why retained earnings? Because depreciation expense, as we have already talked about, is recognized on the income statement. And any expense on the income statement reduces retained earnings. By the way, in terms of some nomenclature, when we talk about purchasing fixed assets, we refer to that as capital expenditures or CapEx. So this company actually made some CapEx purchases at the beginning of the year. In terms of how property, plant, and equipment is reported on the balance sheet, so property, plant, and equipment is reported net of accumulated depreciation on the balance sheet, such that net property, plant, and equipment, which is the line item you actually see on the balance sheet, is comprised of two components: the original cost of all the equipment, property, and plant that you purchased, net of all of the accumulated depreciation that's ever been recognized for that equipment. So in the prior example, by year 3, we're going to show on the balance sheet net property, plant, and equipment of $200, which will be comprised of the original purchase price of the equipment, the $500 price, net of all of the depreciation that we've taken over the last 3 years, namely $300 worth of depreciation. Now, we mentioned the treasury stock is something called a contra account when we were originally introducing the balance sheet. Well, on the asset side of the balance sheet, probably the biggest contra account, which is a negative account, is accumulated depreciation. It's an offsetting account to the PP&E asset. Increases in contra accounts, the more depreciation you recognize on the income statement, the bigger this negative account is going to be because it's reducing your net PP&E. Here we see this with Walmart's description of what's included in their property, plant, and equipment. You see that they report net property, plant, and equipment, but they've identified that it's comprised of gross property, plant, and equipment. So this $155 billion balance represents the historical cost of all the machines that they've bought before accounting for depreciation, any depreciation. And accumulated depreciation represents that for all the machines that the company is currently holding, they have already recognized $43 billion of depreciation over the last X many years. And if you go into their footnotes, they've identified what the makeup is of all of those assets. And they've identified them on a historical cost basis. This 155, which represents the gross property, plant, equipment balance, is comprised of all of these various types of property, plant, equipment. Land is $23 billion. By far their biggest account is buildings and improvements. They own $84 billion worth of buildings. They also own $40 billion worth of fixtures and equipment, and on and on and on. And they're telling you that they've already taken $45 billion worth of depreciation on all that equipment. So the net property, plant, equipment is $109 billion. And that's what they're presenting on their balance sheet. So now let's run through this. This isn't necessarily as easy or as simple to compute as one might think, especially when companies are constantly buying new equipment. So let's go through a scenario to understand what's going on with property, plant, and equipment and how to account for it when companies are constantly buying equipment. So if we revisit our lemonade stand, let's calculate property, plant, and equipment at the end of 2014, 2015, and 2016. Assume the following. $15,000 in new equipment with a useful life of 3 years will be purchased at the end of 2014. So in addition to all the equipment that we purchased, remember we purchased a lemon squeezer for $15,000 in the beginning of 2014. We purchased a lemonade stand for $15,000 at the beginning of 2014, and we purchased a cash register. At the very beginning of 2014, we had $32,000 worth of gross PP&E before we had taken any depreciation. And now I'm saying that at the very end of the year, we also bought $15,000 in new equipment with a useful life of 3 years. And then the next year, at the end of 2015, we bought another $15,000 piece of equipment with 3 years, useful life. And lastly, in 2016, the end of 2016, we bought another piece of equipment. So what I'd like you guys to do now is take a stab at calculating what is going to be the gross PP&E, accumulated depreciation, and therefore net property, plant, equipment for every year for the next 4 years. So basically, January 1st, we know what the initial balance is. What is it going to be at the end of December 31st, 2014? What is it going to be at December 31st, 2015? And what is it going to be December 31st, 2016? Hit the pause button and give it a try yourself. And then when you're ready, hit unpause and we're going to go through it together. Let's go through this exercise. So we added a couple of wrinkles in here. First, recognize that we started with $32,000 in gross PP&E and net PP&E. Accumulated depreciation was 0 when we started our lemonade stand. We hadn't recorded any depreciation yet. And remember that we bought during that year, in fact, right at January 1st, we bought the lemon squeezer. So we got the lemon squeezer. And we bought that for $15,000 with a useful life of 3 years. So that's going to be $5,000 in depreciation every year. Then we got the lemonade stand. And that was the same 15 divided by 3 equals 5. And then we had the cash register, which we bought for 2 and a useful life of 5, which gave us 0.4. So together we had 10.4 in depreciation, and that is exactly what we recognized in the first year. And what that meant is where we started with the gross property, plant, equipment of 32, we had net PP&E of 32. We were going throughout the year at that amount, and we had recognized 10.4 in depreciation, but the thing that we threw at you was that at the very end of the year, December, the very last day, we bought another piece of equipment with a useful life of 3 years. So none of that presumably was depreciated in 2014, but now it added to the gross PP&E balance. So instead of 32, we now have gross PP&E of 47 at the very end of the year. If you looked at December 30th, it would have had gross PP&E of 32. But December 31st, we bought this new machine, so it had 47. And notice, it didn't affect accumulated depreciation because there was only 1 day's worth of depreciation. There's no depreciation effectively. So your net property, plant, equipment, because of this new bit of information, was 36.6. So what you see on the balance sheet at the very end here is 36.6 as your net PP&E. Now, the next year is where it gets even more interesting. Not only do you buy another piece of machinery in the very last day of the year, raising your gross PP&E balance, your accumulated depreciation and your depreciation is going to be changing. Specifically, not only does your accumulated depreciation capture the depreciation from the prior year, but it also captures new depreciation. And what is new depreciation in 2015? Well, it's the same lemon squeezers, lemonade stand, and cash register from before, so you still have the original 10.4, but now you also have a year's worth of the equipment that you bought at the very end of 2014. So you've got $5,000 worth of new equipment that you're depreciating, so 15.4, and that's what this amount is. Apologize for the handwriting. So we look at an accumulated depreciation of 15.4 plus the original 10.4. What we recognize on the income statement, though, is just the current period depreciation expense. What we show on the balance sheet as a reduction to the gross PP&E, of course, is the accumulated depreciation. And we get to net property, plant, and equipment of 36.2. The trickiest one is the final year because there are several moving parts. By the final year, we have the depreciation expense associated with all the other equipment. So we have we're starting with 15.4 because we have all the depreciation from all the prior assets. So we have the lemon squeezer giving us 5 that year. We have the lemonade stand giving us another 5, the cash register giving us another 0.2. And then we have the prior equipment that we've already bought. We have another 5 from the equipment that we bought in the very beginning of 2014. So that was a full year, yet another full year's worth of depreciation. And then, but in addition to that, we have the full year's worth of depreciation from what we bought at the very end of 2015. So although since this ends in December 31st, 2016, we never account for the final piece of equipment, this year depreciation ends up being 20.4. And accumulated depreciation is all of the prior year accumulated depreciation plus the 20.4 or 45 or 46.2 rather. Notice that what you're showing on the balance sheet is net PP&E changing from one year to the next depending on how many assets you're depreciating, 32, 36.6, 36.2, 30.8. What's interesting is had we taken this a little bit further, you realize that by 2017, the original asset, the lemonade stand and the lemon squeezer, are fully depreciated. So that would actually come off the books. And in fact, although it wasn't part of your formal exercises, what you should know is if you didn't buy anything else, and let's just keep this simple, by 2017, we can sort of walk through what the 2017, December 12, 17, what you'd actually see is gross PP&E of 77, because no new equipment is being purchased at that time. But depreciation in 2017 is actually a little bit lower. It's now you're depreciating only 15, only 5 from this asset, 5 from this asset, and 5 from this asset, because the assets that were purchased on January 1st, 2014 are now already fully depreciated. So depreciation expense in 2017 ends up being just 15. So that's an interesting point. It wasn't part of your formal exercise, but just as an FYI, as machines fully use up their useful life, they're no longer counted in depreciation.